Hey guys, I'm just going to make this quick video about question 4 for our financial reporting class. This question confused me a little, so I thought it would be a good question to make a video about. We're asked to do two things in this question. First, to make an amortization table for the lease, and you can see I've transferred sort of the table that they want out of Connect and into Excel. And next we're asked to do some journal entries for 2001 and 2002. And you can see here that I've just sort of attributed real world dates to the interest and payment periods just because I like to do that. Now, I did this question on my calculator, and in Connect, it asks you to use the tables. So I actually have done this question 3 times. I've tested it with the tables, with my calculator, and with Excel. And the question, since I haven't handed it in yet, has accepted all of the answers. The teacher was telling the truth, basically, when she said she was going to adjust the tolerances to make sure that we didn't have rounding issues. So I think no matter what you do, you will be able to get the right answer regardless of how you arrive there, whether you use Excel or your calculator or the tables. So with that said, let's just jump right in and let's start getting the information we need from our question. So we're told that this equipment has a useful life of 6 years, but that we're only going to keep it for 4 because we're going to make 4 equal payments. The payments will be $100,000 each, and we'll make the payments at the beginning of each lease year. So what we know right now is that our payment is going to be $100,000, and we'll remember to enter that as a negative because this is money that's coming out of our bank account. And since this is a lease, since we're going to pay down all of the amount of money we owe, our future value will be 0. We know that our N, or our number of payments, since this is 4 years, and it's a 4-year lease and we're paying once per year, our number of payments will be 4, which means our payments per year will be 1. We're not told about compounding interest in this question, so that means it's also going to be 1. We don't need to worry about that. So finally, we need to handle our interest per year. And we know that the implicit rate of interest is 7, but our borrowing rate is 8. But since we know the implicit rate of interest, that's the one we're going to use. We would only use the incremental borrowing rate, or the IBR, if we didn't know this number here. But since this is given to us in the question, we're going to use 7%. And now we have all of the information that we need to calculate PV. You could either do this in Excel or you could do it on your calculator, and this would be what you would enter into each of those buttons to arrive at the correct PV. But here we're going to use Excel. We're going to press equals PV, and we're going to fill in these arguments that it wants. It wants to know the rate, in our case 7%, the number of payments, 4, the amount of the payments, 100,000, and the future value, 0. Finally, remember, we're making these payments at the beginning of the period, so we're going to press beginning and flag it with 1, then close our bracket. And we're going to see that we get $362,432, and that is the beginning value of our lease. That's the balance when it starts. And we can actually just press equals to link that cell, so we don't need to type it. We don't pay any interest immediately as soon as we start the lease, and we know our payments are $100,000. So we can fill out this entire column right away. Each payment will be the same amount. So now, since we've just started this, and we immediately made a payment, the net amount, since we had 0 interest and we paid down $100, we've reduced the liability of our lease by $100,000 right away. This is the first payment we make on January 1st, 2001. So we can say we paid $100,000, meaning our ending balance is going to be our beginning balance plus our net increase or decrease. And that we know that our ending balance will be the beginning balance of the next period, so we can just link these together. So now, to get our interest expense is going to be 7% of the amount we still owe. So we can do that quite easily. We can press equals, and we can multiply our balance by our interest expense. meaning during the year we accumulated $18,370 of interest on this loan, which is going to go back to increasing our principal. So this time we're not going to have the same amount of net decrease. The amount during the year went up a little. So the amount that we're going to take off when we make our payment is going to go partially to paying down the interest. We have to pay down the interest first before we can reduce the principal. And we can find the net increase or decrease by subtracting the amount of the payment from the interest. So once we've paid down that 18,000 and well, let's just call it the 18,000. So once we pay down the 18,000, we have about 81,000 left to reduce our principal. So now in the exact same way, we're going to add our net increase or decrease to our beginning balance. And we're going to get 180,802. And once more, and now that we've sort of built this, we can just drag this down. We don't need to do any more calculations. So we can just drag this down. And for this one to drag it down, we need to make sure that we absolute value the interest expense, because that will never change. Whoops. So now that we've done that, we can drag this down to get the new interest expense. And we can drag this down the whole way and fill out our chart just like that. And we will balance to zero right at the end. So the other thing I wanted to point out is this $80,000, we don't need to worry about that. Although it says we do have the option of paying that $80,000, nothing in the question indicates that we're going to, or that we intend to retain that asset, or that our management has told us it wants to retain the asset. So we should assume that at the end of the lease, Scotia Limited is going to take our asset away. We're not going to have it anymore. We're only going to keep it for the 4 years we've leased it. So you can see we're balanced here at zero. This is our amortization table, totally filled out. So then the next thing we want to do is we're being asked to prepare all of the entries for the first 2 years. So that's 2001 and 2002. So the first thing we need to do is we need to calculate the depreciation expense. So remember, we're not depreciating this asset over its entire life. We're depreciating this asset over the amount of time we own it. Now, if the asset's useful life would have been shorter than the time we owned it, if this asset only had a useful life of 2 years, we would use that. But since this asset has a useful life of 6 years, and we're owning it for 4, we only need to take into account the 4 years we own it. So we get that number by taking the value of the lease, and we can just link this right here to the PV, plus the life of the lease. And if we want, we can actually just link that to the number of payments to get the depreciation expense. And to get that, we're going to divide the value by the life. This is straight line depreciation because it doesn't really say it isn't. Oops. I made a mistake, but we can fix that. So this is going to be the depreciation expense we're going to recognize each full year we own that asset. $90,000, $90,608. So I'm only going to do the first year because I think that by the time I do the first year, the second year entries should be self-explanatory. Now in this particular question, they want us to split up these two entries. In some previous questions, they did combine these into one entry, and the teacher does occasionally combine these into the same entry. Really just follow the instructions on Connect and you should be okay, but it is perfectly acceptable to combine these into one entry, and in fact you might be asked to. So the first thing we're going to do is we're going to just enter the debit value of our lease, and our debits will equal our credits. Next, we're going to make the first payment on our lease. So this means that our lease liability is going to go down by the amount we paid, and we can just link that to the payment. And we're going to make that payment in cash. It's actually entirely possible that this is accounts payable or another liability account that we wouldn't directly pay in cash. But what this question wants us is to assume that we're paying in cash. So next we're going to recognize the interest expense for the whole first year. And that's up here. Remember, we accumulated $18,370 in interest in the first year. So we can just link those together. And in the same way, you can see that the lease liability is naturally has a credit balance. So when we put in this credit balance, this is actually increasing our lease liability. Finally, we have to recognize a depreciation expense, which we did up here. And this depreciation expense is just the value of our depreciation expense. Now, depending on how you do this question, you may get a different answer here. A couple of times I did get different answers. I got 90,607 in a few. Like I said, the tolerances seem to be very permissive, and the teacher's very good about it, so it did accept both. So I wouldn't worry too much about how precise these numbers need to be, especially since this question asks you to round up to the nearest dollar. With that said, I think that's everything you need to know, and that's the end of this question.